So one of the challenges when you make some money is how much you pay in taxes. And so it's important to have strategies and tools to help you maximize the after-tax benefit of your hard-earned income and any money you might inherit. I'm excited today to have Federick Hubler coming to us from the Philadelphia area, Creative Capital Wealth Management, where they help people with wealth management. He's a fiduciary, and particularly when we talk about DSTs as a tool to help you preserve wealth. Frederick, thank you so much.
Thanks for having me. So the fun thing with the DST is we know what it does from a different title. Most people know of a tenant in common relationship. And the problem with that is if your Thanksgiving is like mine, we can't agree on what to have for dessert. And in a tenant in common relationship, all the investors in that property need to agree. And so about 16 years ago, a company went to the IRS and said, listen, this tenant in common isn't working. When people want to sell a property and 1031 into a role of a passive owner, but an owner of property, the tenant in common does that, but with the stickler of everyone has to agree, and it becomes it became very ugly. So about 16 years ago, the Delaware Statutory Trust, which was always around, was approved by the IRS to be the wrapper in which you can hold real estate in. And there is a managing, it almost sounds like a managing partner, but in the real parlance, it's a sponsor. So they are the role of, they're in charge of everything. And it's typically a brand name of an institution. Cantor Fitzgerald's a good example of one, but there's many others of a name that you've heard of. So there's not anything Creative Capital makes. We just take FINRA and SEC regulated investments that are out on the street. We identify the ones we like. We go through a filter. We get third-party reviews. And out of that, maybe 18 or 19 are on the shelf at any one time. And they run the gamut, just like real estate can run the gamut from student housing all the way to senior living and everything in between that people want to own. So there is no DST that's a strip mall, but there is a ton that are storage or apartments, multifamily apartments, and even a lot of mobile home parks are good DSTs because they cash flow well. And from go ahead, shoot.
Well, I was gonna say where I got involved in this the first time was I had a client who was selling property that her father had accumulated, and as a result was facing a pretty substantial tax bill. And we looked at some real estate investments in terms of what was the best return for her to get for the work that she was doing. And the challenge was that from a tax point of view, she couldn't really get the full tax benefit because she wasn't participating in the property. That she looked at mutual funds and she looked at other products where she was saw a nice return for her money, but that return wasn't eligible for her because she wasn't putting any risk involved and wasn't on the loan. And these DSTs, I believe, are designed specifically for that it's not just like a mutual fund where you're throwing money into a fund. Technically, you are on title at some level with the property, and you have the security of the property, and you have the benefits, the depreciation and tax and such. So what are the advantages? Tell me, and this was as opposed to a 1031 exchange, which didn't make sense in her case for various reasons. I think that's a common misconception. They're the same. What's the distinctions between 1031s and DSTs?
So great question. 1031 is the IRS approved exchange from one property to another. The joke I make is 1031 usually stands for my headache for your headache. Because you're selling your property, you don't want to pay taxes, so you 1031 into another property. There's a bunch of rules you have to follow, but at the end of the day, you end up in a normal 1031, releasing the property and getting into a new property if you did a 1031 outside of a DST, and you just exchange the headaches with a new headache. Because there's no landlord relationship with a property that doesn't come with some level of headache, no matter how new, because tenants change, property, like there's always an issue. So what a 1031 does, that's the mechanism that lets you sell one thing, use a qualified intermediary, which is not us, it's a third party that allows the IRS to say, okay, you never touched the money bill, so we're not charging you taxes yet, but you have to exchange the one property for another property that's of a like kind. And it really goes back to farming days where you and I trading my bull for your bull, but I couldn't trade my cow for your cow. It has to be very similar in financials.
Right.
So you can 1031 into another property. That's not what we do. The DST satisfies that other property requirement. And as you mentioned, when you put 100, 200,000 into a DST, that's a $300 million Amazon distribution center, you get a settlement. You have settlement. There's the QI is there, but you are 0.00000025 owner of the new thing. So it's not a REIT. It's not a partnership. You are actually an owner of a partial owner, very small owner of a very large institutional property. So the benefits to the investor is they get all the landlord benefits. In a DST, you get new depreciation schedule, you get new amortization schedule if there's debt on there. What you're selling might have debt on it, which means the DST you're getting into has to have the same amount of debt or more, or it's not a 1031. You're now doing a bull for a draft. You got to do, cow for cow or bull for bull. So if where we come involved is of the 18 or 19 or 20 DSTs we have approved, all of them have different levels of debt from 0 all the way up to 90% and almost every number in between. So we match what the client wants in an income standpoint, because the minute you're an owner of this, and this is the thing that I think people, just because they're not used to it, in a DST, the property's already built, already tenanted, already cash flowing. You're just your equity from your 1031 going into the DST, or in some cases, and we're able to do this in our cases, you can put cash into a DST. So when the dust settles, it doesn't matter whether you 1031 in or you put cash into it, you're still a partial owner of a very large property that you don't have any control over and you have no work to do. So your equity or my equity going into that DST is just replacing the equity of the sponsor. Already has a tenant in it, already cash flowing. If it's a multifamily, it already has multiple tenants in it. And then your check typically starts the very next month. You're now a landlord of a fill in the blanks. If the state that your DST property is in is a tax-free state, you don't pay taxes on the income at the state level. So there's a lot of DSTs going in Texas and Florida. If it's a taxable state, the property itself has to warrant the fact that, okay, I might be making income, but now I have to show taxes because I have a New York property or I have a property that does taxes at that state level. Our job is to find out from the client what their income is. If you're selling a property, that property was probably generating income. So the first thing we look at is, are there DSTs out there that will replace the income you're missing? And in a lot of times, the DSTs are not going to pay as much as what you're giving up. But when you figure out you're giving up, now you're paying a management company, or in most of our clients, they are the management company and they're a doctor or they're a business owner of something that's not the property, their time value is way more. So in almost every case, if you can find the right DST, you can increase your net after tax income and also free up a lot of time, because now for about 5 to 8 years, you have nothing to do but sit back and watch the checks come in. You get reports on the property, but it's not a mutual fund or a REIT. So the stock market does not affect the value. And most of every DST sponsor we use has history. And that history is documented almost like a baseball card. So there were times when interest rates spiked last year. There were times where there were no DSTs out there that had any debt. And if you had a 1031 that needed debt, you were really you were messed up. Like there's nothing that was out there. And so we didn't have any clients that were without a vine. But at the end of the day, it's not so much I want a DST, because that's like saying I want a car. There's tons of cars out there.
Right.
And so the DST is just the shell or the bag that holds the property. In the DST could be different properties. And one thing we're seeing more of now from a strategy standpoint for us is, if we're in or going into a recession or a slowdown of the economy, whether we call it a recession or not, it probably will be similar to the 70s, an inflationary recession. So the recession is, good things are going bad. And the inflationary part is, and everything's also getting more expensive. We're living that now. So one type of DST that we like to look at is a value add DST. So it satisfies everything we just talked about. And I personally just did one for myself. I sold a property, and I wanted to be a landlord, but not want to be the landlord. I want to own the land, own the property. So it is, and it's closed now. So this is to educate your listeners. I'm not here to sell. I'm here to, as I joked with you, I'm here to serve. But it was a mobile home park in Florida, so tax-free, multiple mobile home, so multiple lots in the one park. But it's a value add DST. The DST itself was generating about 6%. So the mobile home park was generating about 6%, but it was only planning to pay the investors 4%. Now you and I can get more than 4% in cash pretty much anywhere now. So I wasn't doing it for that part, but here's the difference. The difference between what they were paying me and what the park was making, that 2% difference, was going back into the property to fix up the community areas and to expand the amount of lots that had mobile homes on them. So in 5 to 8 years, and the reason it's 5 to 8 is the sponsor isn't going to sell in year 5 if it's the worst time to sell that asset. They'd rather wait. And so most DSTs never live longer than 10. I've never seen anyone live longer than 10 because they want to do their job, give you the money. At some point over time, even just with inflation, you've earned value because, again, these are real properties that have real tenants in them. And so when this DST sells in 5 to 8 years, what they're physically selling is different than what I physically bought. It's now open area community, updated community areas. Maybe they've added 10 more pads. And so that plus inflation will be where I'm more comfortable. And that 4% isn't forever. It's just they're going to do 4% for, I think, 3 or 4 years and then grow up from that, because now we have more tenants. We might be able to, and a lot of these mobile home parks are owned by the family for 30 years. And Mrs. Johnson's never had her rent increased in 30 years. And it's hard to go to her and increase her rent when you haven't increased the property. But when you make the property better, and you can go back to, hey, Mrs. Johnson, now there's a pond and now there's all this other stuff. We're going to slowly, your rent's going up a little bit. And they're not trying to kick anybody out. But those types of DSTs exist. And I've seen them start in the last 2 to 3 years because people want to have a mechanism within that DST that, other than inflation, which probably will lift the sales anyway, in addition to inflation, what else is going to make this thing worth more later? And that takes work, and that takes, better management of the property, which is a big thing. But also, if you can make the property better, that's a no-brainer.
Well, it's like a value add in a multifamily. It's just wrapped
Exactly.
in a DST rather than a standard multifamily transaction where you're more of a mutual fund limited partner. And I think at the end of the day, the thing that I would urge my customers to take a look at, DST is just the format of ownership. The underlying asset has to be a good asset. There's great DST investments. There are bad DST investments. There are great DST investments that are not appropriate for you, for whatever your tax or income situation is. And there are the ones that are very appropriate for you and work well. And the key is to find somebody who has an inventory of product to look at to help match up your needs with what's available. And Frederick, being a fiduciary, does that. So Frederick, I really appreciate the time. I know that there's a very deep topic that requires understanding, explanation for by somebody who's interested. If somebody's interested in learning more or getting with you to see if it fits for them, what's the best way to get in contact with you?
I think our website, ccwmg.com. So what's right behind me? So williammarygreg.com. You can schedule an SOS on there. You can mark, schedule a call, and everybody on my team knows about DSTs. And then happy to educate, happy to walk them through the good, the bad, the ugly. We've been doing this for 20 years. DST's been around for about 16. So prior to that, we were doing the tenant in common stuff. The downside is the alternative investment. It is an alternative investment. So the investor needs to be an accredited investor, which is $1 million, not counting your house. It's not everybody, but some people. Or it could be income wise. If it's a couple and they're making $300,000, that they're considered accredited. So we'll work with them on there. And sometimes if a DST is not the right fit, we're the first ones in the room to say that, because these are not liquid investments. I'm 20 years in the business. I have a clean broker check, FINRA, I've never, and that's because you measure 15 times and cut once. And we never say no to people. We just say, not now. Like, you don't need this now, or this isn't appropriate now, or there's no DSTs out there that we have a quality relationship with. And being a fiduciary, we don't care about the sponsor that you pick. We care that the sponsors are going to be the kind of sponsors we worked with before. And so we have really good relationships with the top sponsors, which means we can have blunt conversations with them, and they keep us up to date on previous DSTs. Because once a DST is out there, and here's the neat thing to close this up, Bill. Let's say you put 100,000, 500,000. Like, you don't have to have $1 million to go into a DST. You just have to have a net worth of $1 million, not counting your house, to be allowed to do a DST. So let's say that 100,000 comes back at 190 in the 5 to 8 years. Because it's real estate, whether you 1031'd in or whether you paid cash in, it's real estate now. And either way, that 190 now can be 1031'd again into another DST. So the capital gains you didn't pay will never get paid. And then at some point, you don't wake up and there's a data death step up, that DST gets a data death step up as well.
Right.
So the only people that I think really don't like DSTs are lawyers, because we're doing all this without a trust. It's just the way it's the way real estate works, and it's the way a 1031 works. And if you can flip, it's called swap until you drop. That's the technical term. But if you can swap until you drop your DSTs, then you have a constant flow of new properties that you can choose and income, and you keep deferring the capital gains. And as of right now, those capital gains will have a step up, and those capital gains that you never paid never get paid by anybody because of the data death step up, which is a really cool thing to do. Again, I wish more people are accredited or were accredited so that they could benefit from it. But it's definitely something you want to have in your back pocket as you're looking at stuff, or as you're inheriting something that you didn't expect. You need to know what the options are and which options are right for you.
Fantastic. Frederick, there's a lot there to unpack. There's a lot more to unpack if you want to write a check, but I think you're obviously a wealth of knowledge for that. Appreciate your time today. I'll have your contact information down below in the description. Thank you so much.
Thank you for having me. Take care.